Howdy, Jacob here. Today we're looking at CRH Public Limited Company in the construction materials industry. 56 billion market cap on 63 billion enterprise value, founded in 1936 out of Dublin, Ireland. 23 billion in 2014 in revenue to 35 billion in 2023. It's not immense growth, but still a very solid amount of growth there. Gross margin increasing, operating margin increasing, both positive signs. A dividend that's been increasing pretty heavily, and most recently is over 50% of their earnings per share, so it could be a pretty large payout. Return on invested capital is also increasing, and still 11.4% 2 years ago, but averaging in the upper single digits. Balance sheet shows 6.4 billion, 6.3 billion cash on hand, with 1.8 billion due short term and 9.8 billion long term. So they do have a lot of cash in relation to short-term debt, and even if you net out their long-term debt, it does look to be no more than maybe $5 billion, and they produce a good amount of free cash flow. So they don't have so much debt that I'm concerned about it, but I do want the company to realize that you can't just keep going into debt, and obviously, and this is what they've done in the last 10 years at least, they've increased their free cash flow more than their debt. And so the ratio that I like to look at is their 5-year average free cash flow, most recent 5 years, compared to their debt. Is it 2 years, 3 years, 10 years, whatever it is? Although their debt is increasing, their free cash flow is increasing more. And so their ratio is going down, which is a positive, but they're still going to have to think about at some point they're going to have to pay it down, or at least manage it a bit more to where they only really go into debt for large acquisitions that they can't fund through free cash flow. And it looks like really only one large net acquisition year they couldn't fund through free cash flow. Well, I guess that's completely wrong. One in 2015, a little bit in 2017, then a little bit in 2022. But outside that, they didn't really need to go into debt to repurchase shares. I guess we'll see whether we think that was an attractive price or not. But you want the company to be allocating its capital well within the capital that it has. And obviously, if there's opportunities, it's not egregious to leverage those. But I do think it takes a very sweet nectar of an opportunity. So let's start making our assumptions here on the revenue growth side. Most recently, they've been growing a bit more. They provide building material solutions. I don't know much about Ireland and the construction business out there, but I'm sure they can grow 4% a year. Let's do market average. Although they've been growing their margins, growing return on invested capital, it's still not crazy impressive. And I don't think their growth is also crazy impressive. As for margins, I think I'm good doing 8 and 9. Buybacks, they do buy back a bit of shares. About $500 million is 1%. So if they bought back about $1 billion, billion and some change, I'm going to add about 2%. Dividend, increased it very heavily recently. The payout currently on a free cash flow basis is probably just a little under 50%. I mean, I'm fine keeping it where it's at. I don't want a company to pay more than 50% unless it's a dinosaur company, extraordinarily consistent with no ability to reinvest back in themselves. So for me right now, the company's stock price needs to fall 46% before you get the return I'm looking for here. I think it's a fine company, just not at the right price for me. So I'll just be waiting patiently and looking at other companies in the meantime. Hope you enjoyed the video and have a great rest of your day. Thanks.